The broadcast is now starting. All attendees are in listen-only mode.
Everyone, let's do a quick sound check and then we can get started. If you guys can hear me and see my screen, you should be looking at the long-term Dow chart, INDU chart. All right. Okay, so I'm going to do things a little bit different today than the normal beginners webinar. It's going to be more of a beginner's review. So I want to take a step back and kind of go over the theory about Elliott wave a little bit, and then look at some of the longer term index charts and really drill down on those charts so we can get an idea of where we're at on the bigger picture and how that all fits together with what we're seeing on the smaller time frames that we deal with on a day-to-day basis. There's a lot of review on a weekly basis, on a daily basis of chart review, smaller time frame. We've got Avi's weekly video. We've got Avi and Garrett's daily live video. So there's lots of information on the site about just basic chart review, but I wanted to make sure we're not overlooking the beginners here and really get into some of the nitty gritty about Elliott wave and some of the details. So that's kind of what I want to focus on today. I don't think we're going to have a lot of time to go over a ton of different charts, but once we get through this, and if you do have a specific chart question, what I would ask is that you ask a specific question, not just, hey, can you look at GDX and tell me what it's doing? I want to hear more specific questions about Elliott wave in general, or theory, or some kind of question that's more specific than just what the chart review is, because again, we have all that information on the site right now. We review that stuff a lot, so I wanted to do something a little bit different today. So happy to answer questions about specific charts, but I would like a specific question about something that's happening that you're not understanding about the theory or the analysis. I'm happy to review that here. But again, more of a specific question. All right, so I'm going to start with a presentation that we have used in the past. I'll try to get through this fairly quickly, but I do want to just go over this again, just so that we can make sure we're addressing the beginners out there and make sure that they all understand kind of where we're at, so we're not overlooking them. All right, so starting on this slide, it's going to be half of this presentation. All right, so Elliott wave, the theory behind the Elliott wave method. So Elliott wave theory postulates that social mood is driven by unconscious and endogenous forces fluctuating in repetitive fractal patterns. Social mood governs the character of social events rather than social events being largely random or the result of external forces. So basically what we're saying is that social mood is what governs all of the things that we see. So from who gets elected to protests in the street to these types of things, rather than those things affecting sentiment. So sentiment isn't driven by any external force. Periods of positive social mood result in rising stock prices, re-election of incumbents, economic expansion. Periods of negative social mood result in declining stock prices, rejection of incumbents, and economic contraction. If social mood governs social events, what governs social mood? The answer is the wave principle. And the wave principle is basically a indicator which we can use to measure social mood. So this is the perception versus reality. So this is the standard view is kind of how what the common knowledge says, or what we tend to take for granted. So the standard view basically says that a recession causes businessmen to be cautious, and the socioeconomic hypothesis, or what social mood says, is that cautious businessmen cause a recession. So if a businessman is cautious, then they cause a recession by contracting. Talented leaders makes the population happy. Happy population makes leaders appear talented. Okay. Company earnings determines investor opinion. Investor opinion determines company earnings. Epidemics cause people to be fearful and depressed. Depressed and fearful people are susceptible to epidemics. A rising stock market makes people optimistic. Optimistic people make a stock market rise. Scandals make people outraged. Outraged people seek out scandals. The availability of derivatives fosters speculation. A desire to speculate fosters the availability of derivatives. So we see lots of new derivatives when we're in a bullish market. War makes people fearful and angry. Fearful people make angry war. Make war. Happy music make people smile. People who want to smile choose happy music. And nuclear bomb testing makes people nervous. Nervous people test nuclear bombs. This last one I added. Headlines make the market move. And my response to that is market moves make the headlines. And this is something that we see all the time, where we'll see the same headline will result in two different actions. So we'll see interest rates rise, the market falls. Interest rates rise, the markets drop. And really, it's how they twist and spin that headline that, based on what happens with the market, they'll make that headline fit what's going on with the market. So if the market drops on interest rates, they'll say market rises on interest rate hike because investors are optimistic about the company earnings or about the future of the economy. There's always something that they can twist the headline to make fit the market movement. Okay. All right, so the wave principle. So we talked about that's the theory. So the wave principle is a indicator on a way we can measure social mood. So because there's so many participants in the stock market, we can use Elliott wave theory to determine what's happening with social mood in the public in real time. And there's no better indicator of what's going on with social mood than what the stock market's doing. So social mood follows repetitive and predictable patterns that can be measured and tracked using financial markets. Fluctuation of stock prices is the result of the changes in social mood. Trends and corrections of stock prices link together to form distinct self-similar patterns. These self-similar patterns reflect the most efficient way of achieving both progression and fluctuation over time. In the same way that phi governs relationships and natural phenomena involving growth and decay, expansion and contraction, and advancement and retreat, progression and fluctuation of stock prices exhibits Fibonacci relationships. So the basics of Elliott wave pattern. So the most basic of basics of pattern of Elliott wave is 5 waves up and 3 waves down. So we've got our five waves are measured in numbers, and our corrective waves are measured in letters. So we've got 1, 2, 3, 4, 5, followed by an A, B, C corrective pattern. And then in a larger degree context, this would form a 1, 2. So this is a most basic of Elliott wave patterns. 5 waves up, 3 waves down. Okay, impulsive waves are numbered, corrective waves are lettered. Market progression unfolds in waves. Went over this. Trending moves unfolds in 5 waves, regarded as impulsive. Counter trend interruption unfolds in 3 waves, regarded as corrective. Impulses are structured in numbers and corrected in letters. Okay, so why 5-3? One wave would not allow fluctuation. So we have 1 wave up, there's no fluctuation, just straight up. 5-3 is the minimum requirement for achieving both fluctuation and progress. The fewest subdivisions to create fluctuation is 3 waves. Okay, 3 waves in both directions would allow fluctuation but not progress. At least 5 waves is needed to progress in one direction, despite periods of regression, simply to cover more ground than intervening 3 waves. So while there could be more than 5 waves, the most efficient form is 5 waves up and 3 waves down to give both progression, fluctuation, and progress. And typically nature follows the most efficient path. So again, 5 waves up and 3 waves down is the most efficient way to get both fluctuation and progress. Okay, so now on to Fibonacci pinball. We're going to talk about how Fibonacci pinball works with our fibs here. Okay, so we've got 1, 2, 3, 4, 5 for our wave 1, followed by corrective wave 2. Then within that wave 1, we've got a wave 1 which typically targets between the 38.2 retrace and the 61.8 extension. That's followed by wave 2, 3, 4, and 5 for our wave 3. Then followed by wave 4, and then our 5th wave up. So this is a full 5-wave pattern following our Fibonacci pinball method, which again follows all of these fibs here as we progress forward. So this is our theory. This is the standard theory that we're watching in Fibonacci pinball. So now what I want to do is I want to step away from the theory and I want to show how this is working on our real-time charts. I'm going to start with our larger degree time frame chart, and we're going to start with the long-term Dow chart. Okay, so we're going back from 1920, the early 1920s, the 29 high. We're counting this as the top of a supercycle wave 1, 1929 high. The crash into the low in 33 was counted as a supercycle wave 2, and then we've been in a large wave 3 all the way, and we're still in that wave 3 into our current trend. Okay, so if we look at our wave 1, 2, we lay our fibs out. The low is actually at 10:05, and I don't have data going back that far, but that was the low that was struck earlier in the 1900s, and it was at 10:05, so we can lay our fibs out there. And this is using log scale. Whenever we do long-term charts, we want to use log scale. So we're going with our log scale charts here, and we've got a 1, 2, and then we're in a large wave 3 to the upside. So for the last almost 100 years, we've been in a large degree third wave up, and we've had fluctuations throughout that 100 years. We've had corrections, we've had retracements during that time, but overall the long-term trend and long-term pattern has been up over this last 100 years. So we can see using our Fibonacci pinball, we've got our wave 1 and our wave 2, and then we've got a wave 1 of 1, which we see hit right in between our 50% retrace. Pull this over a little bit so we can see that. And again, folks, this is, I wanted to do some theory and then review and then move into some charts. So that's why we're kind of doing this for beginners. All right, so we've got 1, 2, and our wave 1 of 3, you can see hit our right between our 38.2 retrace and our 50% retrace. So it was a somewhat smaller wave 1. That then continued to progress forward. We had another wave 1 of 3 here that topped out in 46, followed by another correction for wave 2, and then a long period of grinding action up for a wave 3 that topped out in 66. We had a flat corrective pattern here for a wave 4 of our 3 that bottomed in 75, and then from 75 all the way up until 2007 was where we had the top of our wave 3 of our cycle wave 3. And the 2000 correction we're counting as, we can zoom in there a little bit more. So we're counting the 2000 correction as just a minor degree wave 4, and then followed by wave 5 for our top in 2007. The 2007 top then resulted in a large correction for wave 4, and that then resulted in the rally that we've seen off of the 2009 low that we're currently in right now. So that's where we're at right now. So this large correction we saw in 2007, the financial crisis crash 2007, resulted in the rally that we're in right now. So now if we look at our larger degree fib pinball here, we see that this is following our fib pinball pattern. So we have our 1, 2 that we've laid out all the way back from 1929. We can see we're bouncing off of fibs. In fact, this wave 3 tagged the 161.8 extension almost to the nose. 14,289 was the fib, and we tagged it almost right to the penny. The retrace came and tagged the 138.2 extension, again, very close to tagging that extension. These are fibs that were laid out all the way back from 1929, so 100 years of fibs, and we're still tagging our long-term Fibonacci extensions, even on this larger degree time frame. Okay, so that's our long-term count. That's where we're at right now. So we're looking at, as we're in the final stages of a larger degree wave 5, and potentially in the last of that 5th wave here up, and in the current trend. So now if we zoom in, I'm going to use the SPX chart now because that's what we're all more familiar with rather than Dow. So starting with our 2009 low, we can see this large, again, impulsive action off this 2009 low. And again, we see a very similar pattern, again, a fractal pattern. So we've got a wave 1, 2 up off the 2009 low. We have another wave 1, 2, and again, this wave 1 hit the 61.8 extension almost to the nose before retracing lower for wave 2. We have our wave 3, which hit the 176.4 extension, retraced lower, hit the 138.2 extension, again, almost right on the nose, and then began moving higher. And that's where we're at right now. So if we take these and we look at some more subdivisions of this, we can see we have our wave 1 of 3, and that wave 3 of 3 hit our 123.6 extension, and it retraced, and it hit almost the wave 4 of 3 hit the 100 extension, again almost to the nose, and then retrace higher. So again, this is our fib pinball. We see our waves bouncing off of fibs as we continue to progress higher. Okay, so that's the larger degree pattern off the 2009 low. So now we can drill in a little bit further. That's the weekly chart pattern, and we can drill into our daily chart pattern. Let me go back. I have a question about that. Shouldn't the wave 4 and 09 come back to the 1.0 extension? Corrections don't have to move all the way down to the lower end of support. Going back to 2009. So oftentimes we'll see in very bullish markets, we'll see very shallow corrections, and we'll see things retrace towards the upper end of the retracement zone. And this is what we've seen really since the lows were struck in 29. We've seen fairly shallow retracements on the larger degree time frames. All of our corrections have been, from a log scale, fairly shallow. And also we have our Elliott wave theory of alternation, which we'll discuss in a second here, which also can help us determine if we're going to see a shallow or a more deep retrace for our 4th waves. All right, so weekly chart. So now we can drill into the daily chart on the SPX. And this is where we're at right now. So our daily chart, there's one of two paths that I'm watching here on the daily. The first path would suggest that we're in the final stages of this larger degree pattern that's going to top out and seeing a major bear market that takes us back down potentially towards the 2009 lows. So that's the first path. And again, that's assuming that we're already in primary wave 5 of our cycle of super cycle. So this circle wave 5, that's primary wave 5. That's potentially where we're at right now. And this continued grind higher after not getting that B wave top here in 2019 and towards the end of 2019, not having that B wave top and retracing lower really opened the door for primary wave 4 having already bottomed. Okay, and that's where we're at right now. So we've already potentially bottomed in all of primary wave 4 and are going to see a grind directly higher up towards our primary wave 5. And again, bigger picture, that primary wave 5 could mark the top of super cycle wave 3 here. Okay. So again, always need to keep in mind where we're at, bigger picture, right? So again, on that case, and that's the yellow count that we're watching on the charts here. So under that case, we've got 1, 2, and then we're looking at a wave 3 and then a 4 here. So now let's lay some fibs out on this. And we can put our fib extensions on here. Okay, so we've got our wave 1, and then our wave 2, and then our wave 1 of 1, and then our wave 2. Okay, of 3. This was a difficult part of the count because our wave 2, potentially we saw a truncated wave C here, where our wave 2 did not move below the wave A here. So this was a difficult part of the count, and it still is. Honestly, it's really a tough. This is really an unusual and tough structure. We don't typically see a C wave truncate above the start of the A wave. So that's a tough part of the count. But given how far we've extended here, we really have to allow for that to be the case. So we've got our wave 1 and our wave 2, then our 1 and then our 2. And right now we are currently looking at the top of a wave 3 here, and the bottom of wave 4 potentially. That's all of wave 4, and then with this continued extension higher, potentially already in wave 1 of 5 of our larger degree wave 3, and then that should take us up towards the 3950-ish area for our wave 3, which is the 161.8 extension, and that then potentially takes us up towards the 4,000 to 4311 area, which is our 176.4 extension, to the 4311 level. So that's how this extends moving into the next couple of years off of the 2019 low, assuming that we are indeed following this yellow path. We have our support levels in place here, so we really should be holding 3143 to 3060. Moving below that support zone would really open the door to this having topped in our primary wave 3 here, and this will be the alternate count to where we're topping the primary wave 3. We'll revisit the lows that were struck back here in January and December 2018 for a wave 4, and then one more push higher for wave 5. So that could potentially extend this entire rally out a bit further from a time perspective prior to seeing a top. But on the current path that we're on, if we continue to grind higher, we've got just a few more major tops and corrective patterns before we potentially see that larger degree top in place on the equity charts. Okay, so that's how things kind of break down from a theory perspective, from the larger degree time frames down to the smaller degree time frames, down to the daily charts, and then let me actually even zoom in a little bit further. We'll go to a 60-minute chart on this SPX so we can see how this looks on 60-minute chart. Okay, so again, we've got our bottom of wave 4, and then potentially wave 1 of our wave 5 of 3 here. So again, 1 and then 2, and then continue to push higher for 3, 4, and 5. So again, that's how things drill down even further. Again, we just got fractals upon fractals upon fractals, going from very large time frames all the way down to the smaller time frames. And so again, that's how the theory kind of translates into practice. All right, so is there any questions on that before we move forward? I did have some other questions in the room that I will get to as well, but is there any questions on anything that we reviewed so far? And then I have a couple other questions, and then we can get into any specific chart requests or specific questions you guys may have. Okay, so first question, log versus arithmetic scale. On all of my longer term charts, I use log scale. On the smaller time frame charts, I tend to use arithmetic only because TradeStation doesn't have a really good log scale charting platform. But on all the motive weight charts, which is what I use for my longer term, I use log scale. This is available on site's education tab. You are right, Rod, it is. A lot of the information we reviewed, it is on the educational tabs, and I advise everybody to review those things. I wanted to go over just a few minutes of that stuff for the beginners to make sure that we were able to kind of translate theory into practice on the charts. Does algo machine buying destroy Elliott wave theory? No, we haven't seen that to be the case. You know, we have to remember that computers and algorithms are all using history and what's happened in the past and being programmed by people. So we haven't seen it destroy Elliott wave theory, especially on the larger grid time frames. We'll see some fluctuations in the very small intraday charting, but we have not seen it have much of effect on Elliott wave theory in general. Within this theory, can you also estimate the timing for potential high? Timing is very difficult to determine. Especially with fourth waves can tend to extend and grind out. So it makes timing difficult. Timing is one of the more difficult aspects of Elliott wave to determine. So it's very difficult to determine timing. How would we tell if we're following the white or yellow count on the ES? On the very small time frames on the ES, the ES, I think we're watching blue and white. Sorry, blue and yellow. The yellow path suggests that we are in a wave 1 up off of the January 31st low, and that would be a 1, 2, 3, 4, 5, with today's high being part of a fifth wave. We'd be looking for a corrective retrace, corrective pullback into our 38.2 to 61.8 retrace zone, which, depending on where we top, comes in somewhere around 33.16 to 32.50. So we'll be looking for a corrective retrace into that zone for our wave 2 under the yellow path on the ES and the SPX. And that's this yellow path here. So looking for a corrective retrace back down into the zone, and that should be followed by a long third wave up, followed by a fourth wave and a fifth wave. And that third wave should take us into the spring. Just general idea on timing. So looking for a corrective move back on that second wave on ES. This B wave, it's getting really, really extended here. It's hard to still give too much probability at this point, especially with the potential 5 up here. So this yellow count is really looking much more likely at this point in time. But looking for a corrective retrace followed by a hold of support, and then we should see a fairly extended third wave up again into the spring on that yellow count. The black background is hard to read. It's what I've been using forever, and it's easier on my eyes, but we'll take that into account. Does Avi describe this yellow path? Yes, Avi has the yellow path on his charts, on his 60-minute charts as well. Where to draw fibs in a corrective market, example diagonals. There's some good information in the educational section about diagonals. Diagonals are a little bit, as far as fibs go, are a little bit more unreliable for fibs, and they really can fluctuate, and there's no fib pinball for diagonals per se, and they really can fluctuate. We're dealing with all corrective action, so I look at the 100 extension, the 123.6 and 138.2 are all fairly standard extensions for diagonals, but again, we really see it's all corrective wave action, so there's no real fib pinball with diagonals as far as that goes. Could I talk about why there's no C wave a truncated fourth wave we just went through. Which time frame are we talking about on that? What truncated fourth wave? I don't see any truncated fourth waves. We had, depending on what time frame, I'll come back to that question. For on the ES chart, again, I don't have a truncated fourth wave or short fourth wave. Everything's following fairly well here. We got 1, 2, 3, 4, 1, 2, 3, 4, and then we're in our fifth up currently. Again, and even here I can make 5 out. 1, 2, 3, 4, and then 1, 2, maybe in a third of a fifth here on a really, really small time frames. So I don't see any truncated fourth waves. It's following impulsive patterns here fairly well. Okay. 4311 SPS fib target corresponds to super cycle 3 top. Let me go back to that chart. Okay, so currently off of the 2009 low, we are at the 200 extension at 3383. 4260 is the next larger degree fib at 230 is the 238.2 extension, and then we have some confluence there at the 200 extension to 4311. So right around that 4300 area, we've got some confluence between our move up off of the 2019 low as well as our move up off of the 2009 low. So that's the next major fib that I'm looking at here. If we continue to move up impulsively under this yellow path here, if we hold support and continue to move up impulsively on the yellow path. Does it mean that extensions are unlimited? Extensions are when we're in the heart of a third wave up, extensions are always possible, probable, and somewhat to be expected. Now that being said, there are some standards that we look out for when we're dealing with index charts. We typically see our third waves fall somewhere between the 138.2 and 200 extension. That's fairly standard. If we get beyond the 200 extension for a third wave, at that point we really need to start questioning whether we're already in a fifth wave higher. But it's not unusual to see third waves extend beyond the 200 extension, but it's less common. So we typically see things indexes hold near the 200 extension. Where would you stop on this pending yellow wave 2 count be placed 32, 34, or 123.6? I don't know what time frame you're referring to, but let me just show you the setup that may be forming here on the SPX. So on the SPX, if we're dealing with this wave 1 here and we're topping this wave 1 and we get a corrective retrace for wave 2, then our invalidation of that wave 2 would come in here at this 32.13 low. That's the 1-2 setup on the SPX. So as long as we're over 3150, 3,100 is the path open to 3,500. This could mean it is time to get fully invested. I missed that. As long as we're over 30, longer term support is still here at 3162 to 3090. So that's really longer term support. As long as we're over that zone, whether we're following the blue path or the yellow path, then we're still in an impulsive count higher. More immediately bullish setup invalidates with a break of 3186, but again, we do have support just below that at 3162 to 3090. So that's our intermediate support area. And again, as long as we're over that zone, this is still poised to push higher under an impulsive path. Below that 3090 area, that opens the door to this having topped in all of wave 3 and potentially revisiting the lows that were struck back in December of 2019. But as long as we're over that 3090 area, then this is still poised to push higher, regardless of whether we're in the blue path, which again I think is less probable at this point in time, or the yellow path. I was talking about the ABC in blue. C never happened. Okay. ABC, yeah, the C didn't happen in the blue path. So under that case, there is no C. We're following this yellow path. So this under the blue path, it's an alternate at this point. So under the blue path, we're still looking for top in the yellow and the blue wave B, looking for a C wave down. But the alternate would be that's the alternate at this point in time, and the primary is that we bottomed in wave 4. So we have it's actually WXY patterns. We have WXY for a fourth wave here. So it's a more complex corrective pattern, but we bottomed in the yellow wave 4. So we've already bottomed in wave 4, whereas the blue path suggests that we still are looking for that C wave down. Okay. Question on GDX now. So if there's no other questions on the index charts, we can move on to some other questions, specific questions about some other charts. Can go over some metals or VIX or some other charts if there's no other SPX charts. So if there's any questions about the analysis, feel free to ask those now, or just any specific chart questions. We have a little bit of time left, so we can dig into that a bit. Yeah. Okay. Yeah. That's a good point. Let me talk about WXY patterns a bit, because that's always confusing. So before we move on. Okay. So let me drill down a bit on this. Okay. So under this blue count, we had an A wave. So we have three down for this A waves: A, B, C for A wave. And then we had a corrective retrace higher, and then looking for a 1, 2, and then looking for a long third down for our C wave. So what we should have seen here, if this was going to follow C wave down, we should have seen, let me just show you what should have happened under the C wave. We would have had a 1, 2, 3, 4, 5 for wave C, and then that would have been our bottom of wave 4, and that would have looked like that. So that would have been the ideal, most simple, straightforward pattern. There's no B there, and the B would have been on top of this level there. That would have been the most straightforward pattern. A, B, and then 1, 2, 3, 4, and 5 down towards around 3150-ish in that range, and that would have been right in the heart of this support zone for our wave 4. Instead, what appears to have happened, because again we do have an impulse up off this low, it looks like we got a WXY pattern for this fourth wave, and what that looks like is W X WXY, where are we? 4, and that's our yellow path here. Okay, so WXY, and then the Y wave is also a three-wave structure. So the Y wave is then a V, and then C. Okay, so the A waves and the W waves are the same. They can take the form of the same structure. X wave can take the same form of a B wave. So up until this point here, until this high that was struck at 3294, we basically have the same corrective structure that we had, whether it's an AB or a WXY. What happened was we failed at the 138.2 extension, and we shot higher. We broke back over the 3285 level, and validating this down as a full C wave, because C waves, remember, have to be 5 waves. Whether it's a diagonal, ending diagonal for 5 waves, or an impulse, we only got 3 down. It's clearly 3 down. So A, B, C. So it's a Y wave, and then bottom of 4. So basically, a WXY is a pattern where the C wave fails to follow through in 5 waves, and that's why we have to count it as a Y wave versus a C wave. Okay, so that's what happens. It's not a truncated C wave. It's a different pattern, the WXY. Okay. Takeaway: corrective patterns are unpredictable, and structure of the wave retraces are not pinballish. The impulse within a third wave is the only structure in a corrective pattern that we can use fib pinball for the most part. Or if we get an impulse in an A wave, which is less common, but any impulse follows fib pinball. But typically typically C waves most of the time follow impulsive patterns. Okay. Avi has a blue box approximately 3387. Is that still valid? Let me look at his chart and I will tell you. We can look at that. $33.87. He has resistance at 33.87, so that's bullish resistance. Moving above that. Okay, so let me go over this on Avi's chart here, so we're all on the same page. Okay, so this is Avi's chart. So the question: Avi has a blue box at 33.87, so that's bullish resistance. So what he's looking at here is whether we're in a more immediately bullish path, and that would be a 1 and then 2 as shown in green, his dark green here. So what Avi's suggesting is that if we break over the 33.87 level, it would be more supportive of already having bottomed in all of wave 2 here versus seeing a retrace for wave 2 into this yellow path. And that's what he's showing here. I think this move up off of the January 31st lows counts best as 3 waves, which is why we're still looking for a local top, at least under this yellow count. But again, that's his bullish resistance level there. and that's the 50% extension of it's the 261.8 extension of the move up off the low, as well as the 50% extension of this this initial move here. So again, extending beyond 268 is a little bit less common, so that's why he's showing that as bullish resistance. Okay. All right. GDX, we had a question on GDX. Let's see. There's that. We're going to follow the yellow path, then GDX should go deeper correction instead of wave 3 up. Which time frame are we referencing on that GDX? Okay, I think they're talking about Avi's daily, so let's look at that real quick. Yep, okay, I got it. Yeah, so on Avi's daily chart, so what he's watching here, he's got 1, 2, 1, 2, and then 1, 2. Under the yellow count, the green count suggests that we're bottoming in a wave 2, whereas the yellow count suggests we're bottoming in a wave, or we've topped in a B wave and looking for a C wave down, back below. I have that same count on my chart. Still here. Okay, so my white is obviously green, just for reference. Okay, my yellow is yellow. Get rid of that. Okay, so the okay. So let's just look at the bigger picture, and then I'll zoom into the smaller time frames here. Okay, so bigger picture again: 1, 2, and then 1, 2, and then 1, 2. This is the primary under the green path. All right, and then so zooming in, this is our wave 1 up off of the 25.95 low. Okay, and then we've got A, B, and then looking for a C down. So again, C waves need to be 5 waves. So we've got 1, 2, 3, 4. Need one more low for a wave 5 of C of 2. Support for that wave 2 comes in at 27.55 down to ideally 26.94. That's the 76.4 retrace. Ideally, we want to see that hold. Doesn't invalidate until 25.95. If we're in that B wave count, then we'd be looking for a C wave down back below 25.95, and yes, it would take more time and see a deeper retrace prior to moving higher again, and that retrace could potentially move as low as 20.24 without invalidating. That's the start of the previous wave 2. But with that being said, this action down off of this 29.83 high is really not what we typically tend to see in the heart of a third wave down. So even if we are under this following this alternate yellow count, it's likely going to take the form of a diagonal for this C wave, and it probably takes a lot more time to complete. But as of right now, everything is still pointing pretty well towards this finishing off down towards holding over 26.94. It's just a lot of overlapping corrective action to the downside so far. I would like to see one more low though to get us a full 5 down off of the high that was struck at 29.83. All All right, any other chart questions that we didn't go over? Oh, someone's got their hand up. Let me see if they have a mic. Yeah, Scott, do you want to, let's see, do you want to, I can unmute you, Scott. You have a mic? You want to ask your question? You still have a question, or do we answer that? Okay, GDX, how can 4 go above 11? I don't follow that question. How can 4 go above 11? 2. How can 4 go above 2? It hasn't. 4 hasn't. This 4 here, we haven't gone above 2. Where 2 is up here at 29.23. It's in wave 4 is in the zone of wave 1 because we're in a diagonal. If that's the question. So wave 4, we're looking like we're in a large diagonal here. And under diagonals, we overlap, or wave 4 and our wave 1 overlap, but it has not exceeded beyond the start of wave 2. If it does, then it's invalid at 29.23. GDX is the buying opportunity above 29, or where is it? Again, you need, depending on what your timeframes are and what you're looking to do as far as your structure, that there's buying opportunities short term. If we make another low, longer term, you may want to scale in. It really depends on what you're trying to do, but from what your personal risk tolerances and timeframes that you're looking at. But again, always want to look at the bigger timeframe charts. And we're still in a very bullish potential nested 1-2s, but we need to see where, again, what your personal timeframes are. If you're looking for a longer term investment, then the buying opportunities potentially now, and you could scale in if it continues to move lower, and know where your stops are on the longer time frames. If you're looking more of a short-term trader, then you may want to wait for a more immediately bullish setup. Again, it really depends on what your time frames are. C waves are always 5 waves down. What about the A waves? Also 5 waves, or can be 3 waves? A waves can be anything. So they can be 3 waves, they can be 5 waves, they can be WXY structures. They could be diagonals, leading diagonals. A waves can take pretty much any shape, impulsive, anything. So. Okay, I know not to ask about B waves being anything but unpredictable. Yes, B waves are a very unpredictable part of the pattern. B waves within 4th waves are even more so. Updated chart of CTL. I don't have CTL worked up. Again, those can be covered in stock waves. Those stock charts. Okay. Had a question on VXX. Just go over this real quick. Just seeing how this compares with SPX. This was very, very sticky over the past week. So while the SPX and the ES and the NASDAQ were all exceeding their previous highs that were struck back in late January, the VXX held support for quite some time. It finally broke down today and started breaking below some of our FIB support levels. So this is looking like it's probably following a similar path to the SPX, where we may have 5 down, 1, 2, 3, 4, 5 for an A wave, and I'm looking for a corrective retrace for a B wave, and then a C wave down to finish off a larger pattern. The VXX in general, its larger degree pattern is looking like it's still a diagonal. So it's not going to follow the SPX pattern quite as cleanly because the SPX is following an impulse where the DXX is following a diagonal, a large diagonal. So I'm looking for all ABC moves, but it does look like we're in an A down now, with a 5 down, looking for a corrective retrace for a wave B, and then that should fall by C wave down, lower again, down towards 11-ish, potentially as low as 10. Probably see a reverse split around that time. Could you talk a little bit about how to think about light wave theory and pullback in trading terms? PB pinball. In pinball, in trading terms, what to expect. Sometimes waves truncate, but often we are looking for them to hit fibs to the dollar, so it's confusing from that perspective. Okay, so there's a difference between support and targets. So our support zone, let me go back to this larger reach chart here. Okay, so there's a difference between support and it's not great. Let's see what I can do here. Let me find a chart that has some support levels from the past on there. Okay, this is a good one. Okay, so there's a difference between support and targets. So when especially when we're in a trend, in a bullish trend, whichever way the trend is going, or we can lay out our targets on our fib pinball levels. So whether it's the 161.8 for a third or 176.4, and we lay out a box there. And when we're trending up, typically we will hit those targets because the trend is up. So and our fib pinball works really well for that. But at the same time, when we're trending up and we're in a very bullish trend, we have standards on our fib pinball retracement zones that we can look for. And actually, it's good for that. Pull that PowerPoint down. Show this. We good. Okay, that's good. So we have our standard targets, that we're looking for on our fib pinball. So we have 1, 2, and then 1, 2, and then our 3 and our 4. So we have a standard target of the 100 extension, but in a very bullish trend, we don't have to retrace that low. And then also the same thing goes for our fourth wave here. We don't have to retrace that low. We could retrace as high as the 123.6. We could see consolidation through time. We could see this turn into a triangle. So we could have an A, B, C, D, E, and just get a consolidation through time. So our support levels, even though we may lay out blue boxes on our support levels, those aren't necessarily target zones. So ideally that's where we would like to see the fourth wave in particular move to. In a very bullish trend, we don't always see that. And we'll oftentimes see more shallow retraces rather than hitting that support zone. Whereas targets more often are hit in bullish trends. Okay. Sorry, I lost my questions box there. Okay. Do I ever consider the GDX gold ratio? Personally, no. I don't follow it enough to really. I'm following too many other things, but I don't personally follow the GDX to gold ratio. Okay, we're coming up on an hour. Are there any other questions, folks? Any other charts that we have specific questions on that we'd like to see, review? Happy to do that. If there's anything else. But again, I wanted to kind of, take a step back and go into a little bit more theory. I know it's a little bit different than normally on these webinars, but wanted to take a little bit more time today and slow things down a bit. So hopefully that was helpful to some folks. Wave 2 pullback. Wave 2 pullbacks should hit. Okay, wave 2 pullbacks are more reliable than fourth waves, so they really should hit between the 38.2 and the 76.4. They don't always do that though in very bullish trends, and often when you're in the heart of a third, you'll see a more shallow pullback for a wave 2. But when you get those shallow pullbacks, it's much more difficult to lay out our fib, or to really know that the breakout is an actual third wave, because it's difficult to determine between the difference between a second and a fourth wave when you get very shallow pullbacks on the second waves. And oftentimes, again, when you're in the heart of a third, you'll see shallow retraces in the second waves. But ideally, you want to see the second waves hit at least the 38.2 retrace. Silver, I'll take a look at silver real quick with just a couple minutes left. I don't have a real updated WTI chart. It's really messy. I would follow Avi on that, or Arkady. But I'm happy to review it if you have a specific question on it, on the analysis, on either of those analysis. I can take a look at it. I don't have anything to add to what they've already noted on that. Silver's really sloppy also correctively here. And we have a potentially completed pattern here, but it's really not all that clean. So I'm really watching this larger degree support zone for this potential wave 2 bottom. It's possible it's already bottomed, but given where we're at in the GDX and gold looking like they need another low, I wouldn't be surprised for silver to still see another low. And this is really a very sloppy corrective pattern. It's really hard to make much out of it, especially if we do break this low that was struck at 1725 in the futures market. So I'm really looking at this 1711 area for support for the wave 2. And again, what form this corrective pattern takes is a little bit up in the air at the moment. But I'm still looking at this wave 1 from 1656 to 1890. That's really what I'm focusing in on right now. So wave 1 and then 2, and ideally I'd like to see 1711 hold. Again, there's a very sloppy corrective pattern here that we have off of the 1890 high. All right. Thanks, everybody. Appreciate it. Thanks for the questions. Thanks for hanging in there. Again, I hope that that was helpful to some folks and not too disappointing to others. All right, guys. Take care. Have a great week. I'll see you again in 3 weeks. Next week, you get Zach or Garrett. Don't recall offhand who it is right now. All right, guys. Take care. Have a great week. Feel free to ask any questions in the room as well. All right. Take care.